Okay, sounds good. Thanks a lot, David. It's a pleasure to be here. Today we're going to talk about trading and hedging in today's hot commodities. Actually, mostly trading today. The topic changes with the markets, and markets are moving. If you're not familiar with who I am, my name is Carley. I am a futures and options broker. I live in Las Vegas, Nevada. We run a boutique brokerage called DeCarley Trading. We offer everything from full service trading to online trading and everything in between. If you have any interest in market analysis, charts, those sorts of things, check us out on social media. I also post dog pictures, obviously. For anyone that follows me, you know that. Oh, and here's one here. This is Frankie, my beagle. You'll get to know her if you follow me on social media. And believe it or not, I like to show these pictures. Most people think of Vegas as desert and boring, but it's actually very beautiful. This is 20 minutes outside of town. We have hiking trails and elevation and trees. I already mentioned that I'm a broker. I'm a strategist. I write newsletters for our clients and we offer trading ideas. You're going to see some of those today. Some of them are good, some of them are bad. The idea is to basically stay in the game and not lose your shirt until things start going your way. That's the goal. I also contribute to Mad Money with Jim Cramer, Bloomberg Television. I appear on RFD TV a couple of times a week. And oops, I need to update this slide. We've actually combined the financial futures report and the DeCarley respective. So the financial futures report actually no longer exists. We just mentioned analysis on treasuries and stock indices within our commodity newsletter. And one last thing that I will mention, if there's anything that we talk about today that you have any interest in learning more about, I've written multiple books. The three that I would recommend are the three newest and most current, obviously, Trading Commodity Options with Creativity, Higher Probability Commodity Trading, and A Trader's First Book on Commodities. If you can buy them at any book outlet, obviously Amazon's cheaper. If you do go to Amazon, you're going to see quite a few others listed. Just ignore them. They're previous publishers. They're out of print, out of date usually. So these are the only three you should consider. And before we get started, I just want to make sure everyone understands that there's a substantial risk in trading futures and options. What we do at our brokerage is, first of all, we do specialize in hedging. So we help a lot of farm clients, farmers, ranchers, those involved in the commodity business. We help them to hedge their price risk. We also do some portfolio hedging. So if you have some stock exposure that you want to hedge, we can do that as well. But the vast majority of people that are participating in futures and options are speculating. So there's no guarantees of success. I mean, obviously we hope you make money, but there's no guarantees, and you're not earning interest or dividends. And it's not like the stock market that just always goes up over time. Commodities are really tricky. Commodities trade sideways most of the time. In fact, believe it or not, commodities go up faster than they go down, but they go down a lot more than they go up, if that makes sense. Most commodities are kind of in perpetual sideways to bear markets with an occasional gangbuster rally, which is what we've seen in the last few years. All right, so I'm not going to focus too much on why trade futures and options as opposed to trading stocks, stock options, ETFs, that sort of thing. But I'm just going to mention it. If you want a copy of this list or a copy of these slides, just email me and I'll send them to you. But the idea is commodities, futures and options mostly trade around the clock, 23 hours a day for most products. Some products only trade during a day session. For example, the livestock markets are only open for a handful of hours. The grains are open, not quite around the clock. There's some big pauses in there, but for the most part, you can trade commodities around the clock. And that includes options on futures. You get free leverage and margin. Leverage is a tricky subject. It can work for you. It can work against you. You love it when it's working for you. You hate it when it works against you. I'm going to show you a few ways to decrease leverage while still utilizing it using option spreads. Commodities generally have low account minimums. You can sell options, premium collect, or trade option spreads with a pretty small account. I mean, 5,000, 10,000, you can do it. Stockbroker is probably going to ask you to put in 100,000 or at least 50,000, but most are looking for 100 to do those sorts of things. There's no interest charges on borrowing fees. So if you are trading on leverage and using margin, they're not going to charge you interest on it like they would in a stock account. And again, some people can handle leverage, some people can't. It's not for everybody. Finally, I'll mention there's tax breaks for commodity traders versus stock traders. There's a 60-40 blend between long-term and short-term gains, no matter how long you hold the trade. And the most important thing is, at the end of the year, you get a 1099 with a single number on it. It's a profit or loss figure. That's all you have to give to your accountant. You don't have to give line by line, trade by trade information to your accountant. He doesn't have to report it for you. Okay, let's get to the good stuff. Again, if you really want that list, I'll send it to you. But the bottom line is the downside of trading commodities is the leverage, because not everybody understands the risks, and it's very easy to underestimate those risks. But for the most part, it's actually a very advantageous way to access the markets, especially commodities. If you're trying to trade commodity ETFs, there's a lot of inefficiencies in the system. There could very easily be situations where the commodity goes up and you don't make money because of the rebalancing and the administrative costs and the contango. So if you truly want to speculate on crude oil or natural gas or any of those markets, commodity markets directly as opposed to indirectly through ETFs are far more efficient. Later in this session, we're going to talk about a couple of ways to play the energy markets with relatively low risk. I'm not going to say no risk, because there's obviously always some risk, but we've got a few ideas on how to tame it or at least mitigate it. It's really hard. I mean, despite the correction that we've been going through in the stock market, it's really hard to open the newspaper, look at Twitter, turn on the TV without hearing about the amazing bull market in the equity markets that we've experienced over the last couple of years. In fact, if you really want to talk about this bull, you'd probably have to go all the way back to the financial crisis. You can see from this graphic, I'm not trying to point out anything other than the very big picture. Prior to the financial crisis, and if you remember, the financial crisis is when the Federal Reserve, the US Central Bank, and actually, to be honest, central banks around the world all started kind of colluding. They all started getting aggressive and creative. And this is when they implemented quantitative easing. Quantitative easing is basically, it's a little more complicated than this, but I'm going to keep it simple. It's basically money printing or injecting money into the economy, increasing the money supply to make it seem like there's economic prosperity. Now, you can argue in the financial crisis, we probably needed that. Things were pretty dire. I lived through it. I'm old enough to remember the pain. So I understand why they did that. But the problem is, once you start drinking that Kool-Aid, it's addicting. And we've just continued to step on the gas on those types of programs. And what it's really created is a very massive appearance of prosperity and wealth that may or may not be sustainable. You know, the jury is still out. In my opinion, it's eventually unsustainable. But to be 100% honest, we've been hearing these sorts of things for years, and somehow we keep kicking the can down the road and making it work. So I'm not trying to tell you to sell all your stocks and go cash. I'm not trying to do that. I'm just trying to give you the really big picture so we can understand what's been going on the last couple of years and maybe even the last decade or so. Another thing to keep in mind, we've seen really abnormal stock market performance, which is amazing. And especially the concentration of it has been amazing. Obviously, the last couple of weeks or the last month has been a little rocky, especially for some of the big names like the Mag 7. But that's to be expected. Stocks aren't supposed to only go up. And to be quite honest, what we've seen is the exception, not the rule. I personally feel like what we've done as a society is we've borrowed prosperity. We can blame it on the government because we can say, you know, not only did we print a lot of money, we spent a lot of money. The government spending boosted GDP pretty significantly the last handful of years. According to this, in 2023, government spent about 34% of GDP, meaning we bought gross domestic products. So we were spending money to inflate the GDP. Prior to that, the average was about 25%. So we can say it was only the government, but the reality is it's us too, right? Consumers have maxed out their credit cards. They've taken out big personal loans. So it's not just the government, it's us too. Everybody's decided to get a little bit drunk on leverage and debt. This worries me. Again, I'm not trying to scare anybody. I'm not trying to talk anybody out of owning stocks or anything like that. All I'm saying is let's look at the big picture and then adjust our risk tolerance from there, or our risk expectations. I think you can see my cursor, hopefully. On the left-hand side of the slide, you see that there's these gray lines are recessions. You can see they're relatively frequent. Every 3 to 5 years, there's a recession. And then as we get later, and particularly past the financial crisis, we don't really have any recessions at all. Even the COVID shutdown triggered a very tiny, tiny recession, and some would even argue that it didn't, based on rule changes and things like that. This is probably unhealthy. This is probably a sign that we are either buying or borrowing prosperity. And another way to look at it is we're pulling prosperity forward. So instead of waiting for prosperity to naturally occur, we're forcing it. And I'm saying this as a society, all the way from government to people. Now, how it ends, I don't know. This is Warren Buffett's indicator. He does a pretty good job at risk management, I'd say. Now, he gets criticized for leaving money on the table, but I think he's onto something. I'd rather leave money on the table than be in a market that I don't want to be in. So this is a very telling chart. You can see that according to his indicator, which is pretty simple, it's the total stock market value. And that's not just the S&P or the NASDAQ, it's the total stock market value divided by GDP. And according to Warren, or Mr. Buffett, I should say, this ratio tells us how realistically priced the stock market is. And you can see we've only seen the stock market beyond 2 standard deviations of this model a few times in history, and it really hasn't ended well. The most recent was in 2023, and I think we all can remember that was only a few years ago. There's a pretty sizable correction. I think the S&P pulled back 25%, if I'm not mistaken. The NASDAQ was even more, 30, 35. And here we are again. This is as of December 31st, so it's a little bit dated, but even the recent pullback that we've seen still leaves the index, or this particular ratio, above 2 standard deviations. So we're still overvalued based on reasonable metric. I've been showing this chart for quite a while, probably a year. It hasn't really changed. The stock market keeps going up and the bond market hasn't done a darn thing. So keep your expectations tempered. This type of analysis, you can see this chart goes back a little over 20 years. This is not to try to predict what's going to happen tomorrow, next week, next month. This is what's probably going to happen in the next, let's say, 5 years. There's definitely a relationship between stocks and bonds. Sometimes it's correlation, sometimes it's not correlation. But in the end, we always come back to some sort of equilibrium and they tend to balance out. And I think that's probably what we're going to see. We can see that both of these markets are stretched to complete extremes, which is really, really rare. The last time we saw this was in 2020, and it was actually the opposite. You can see this box here. Okay, sorry. I'm going to get you can see in this box here, the red bars, by the way, are treasuries, the 10-year note, and the green is the equity market. So in 2020, when all heck broke loose, investors threw money into treasuries almost without recognition of price. In fact, without recognition of price. They weren't worried about return on their capital. They were worried about return of their capital. They sold all of their equities, bought treasuries, and we got this really big divergence or spread between the two. But it came back. It always comes back. It just might take a while. So I expect stocks to start moving their way to an equilibrium and treasuries to do the same. I don't know what the catalyst is going to be. I don't know if it's going to be tomorrow or 6 months from now or a year from now. I don't know. But in my personal choices, I keep this chart in mind. Whenever I get FOMO and feel like I don't have enough stocks in my portfolio or I have too many treasuries, I look at this and I remind myself, the short term is noise, the short term is temporary. In the long run, stocks are overvalued, treasuries are undervalued. One more picture not to scare you, but to just make you aware of history. We should all be aware of history. History tends to repeat itself, or if it doesn't repeat itself, it rhymes. We have seen euphoric stock markets before. They don't always end well. Let's say that I'm right and the S&P is overvalued. That doesn't mean it can't make new highs. That doesn't mean it can't go to 6,500 or whatever the case is. But let's say at some point reality sets in and suddenly, the government starts pulling in the extra cash out of the economy, or we go into a recession, or whatever the situation is. Let's say that the stock market decides maybe we shouldn't just be throwing money into stocks only because they're going up. Maybe we should pay attention to math and earnings and those sorts of things. If that happens, we'll be lucky if the market trades sideways for a couple years to catch up to the numbers, to catch up to the math. If we're not lucky, we might get something like this. The Nikkei had a euphoric historic rally in the late 1980s. It peaked right around 1989, 1990, and we just barely, when I say barely, I mean like within the last 6 months, I believe, made a new all-time high in the Nikkei. So it took not just a single decade, but over 2 decades, almost 2.5 decades, to get back to those highs. Okay, so now let's look at our situation. When we look at a daily chart, it doesn't seem like we're in a euphoric market, especially if you look at a daily chart that includes the last 3 weeks. But if this is a monthly chart and it goes back to the early 2000s, and I think it's pretty obvious that this is the definition of euphoria. The market is not built to incline in a slope quite like this. Now, there's a lot of reasons why this can happen and did happen. And a lot of it's innovation. Obviously, we've got the AI boom. We've got all types of exciting things going on. But the real culprit is money supply. If you look at a chart of money supply, as the government rushed money into the economy to save us from COVID, everything just started to blow up. Sorry, I'm not very good with this little drawing tool yet. This is the COVID low. This is when the government shot a bazooka of money into the economy. And we got an immediate euphoria, a setback, which was well overdue. And to be honest, in my opinion, I think this is the natural trading range of the stock market. I think we should be in here. If you take all the government money out that, you can argue whether it was needed or unneeded, whether it was a good decision or a bad decision. I'm not saying either or. All I'm saying is you take all that extra money that wasn't naturally created or naturally embedded into the economy, we're probably trading between 4,600 and 3,600, not 6,500 and 5,000. So it's completely altered the trajectory of the markets. Does it end with a return to this trading range? I think probably eventually it does. I don't know when. I wish I did. My portfolio is constructed in a way that kind of expects that. That doesn't mean that I won't, be tempted to start putting money to work back in stocks if we get here, or, as a futures and options broker, maybe we'll start recommending long trades if we get down into these areas here. I don't know. We'll have to see how it goes. But the reality is we probably have no business being up here if it wasn't for government stimulus. And that's just my opinion. Everybody has different opinions. Yours might be completely different. The one thing that I found shocking here in the last couple of weeks during this correction is, it's been a quick correction. It's been a big correction on a point basis. But in the overall scheme of things, you can see we're really not that far from all-time highs. I mean, I think the correction was so far at the low, we were 10, 11% at the most for most indices, or for the S&P anyway. I mean, that's nothing. As someone that lived through the financial crisis, and I remember the 30% pullback during COVID that happened in a couple of weeks, this was really just a normal run-of-the-mill correction. Now, it might turn into more. We don't know yet. But it was really silly for me to experience the panic and, people begging for the Fed put or the Trump put to, the governments to take action when, in my opinion, the only reason we're up at these prices that probably aren't mathematically sustainable without government money is because of the Fed put, or whatever you want to call it. So it's going to be really interesting to see how this plays out. But these type of returns in the stock market are the exception, not the rule. So we should proceed accordingly. Another thing that we found very interesting in the last year or so is the correlations between markets that should not be related whatsoever. And so we've been kind of putting our radar out for these sorts of things so that we can, as speculators, we're trying to predict what's fake and what's not. And it's a crazy environment out there. This is what I'm talking about. So if you notice before, okay, sorry. Once again, the tools got me. So this is before Trump was ahead in the polls and won the election. And you can see this is pretty normal. The orange is corn, the red is live cattle, and the black is crude oil. And you can see each of these commodities are doing their own thing just as they should. There's really no reason crude oil and live cattle should be trading in the same direction, or even corn and crude oil. They really should be doing on their own paths based on supply and demand fundamentals. But that's not what we saw. Once Trump started coming ahead in the polls, we started seeing these massive inflation hedges. And the reason I can tell they're inflation hedges is suddenly everybody was buying these three commodities simultaneously. If you looked at intraday charts, it was almost like they were the single asset. Look at how closely these bars are trading together. Probably a lot to do with algos. I'm sure there was some algos doing it. The idea at the time was, when Trump was first elected, most people were expecting inflation. The idea was higher tariffs means higher inflation, and oops, we better hedge that. So they hedge it by buying commodities. I believe this was probably, I think it's been proven, it was probably incorrect. My personal belief is the tariffs will actually cause deflation, not inflation. That's a whole nother conversation. The reason being, I think it shakes things up enough to maybe slow the economy down a little bit, and that in itself is deflationary. So that's my opinion. I know everybody has different opinions. But you can see clearly from the price action, somebody thought that it was going to cause inflation and they hedged accordingly. what I take from this chart is, well, a couple things. If you see these kinds of moves that lump 2 or 3 markets together, they're moving in lockstep when they have no business doing that, it's usually temporary. So it's a clue. If you're a speculator, you might say, wow, these markets are moving together. This makes no sense. Why is crude oil and live cattle acting like they're the same market? And it might be a place to play the downside when you see this sort of thing, because those types of things are unsustainable. People are buying just because it's going up, or they're buying because they want to hedge inflation. They're not buying because there's a shortage of cattle or corn or crude oil, at least not during this time frame. Actually, I will add, the thing about what we've seen in the last couple of years, this right here is not just Trump. We had a few years ago, 2021, 2022, 2023, we had a period of high inflation. And there were commodities that were going up just because people needed to hedge their inflation and they didn't know how else to do it. So they bought crude oil, they bought corn. Now, crude oil had a pretty good story. The Russian invasion of Ukraine, so obviously that was part of it. But even before that, there was some inflation hedges coming through. If I'm right about inflation turning the corner and starting to at least stabilize or go lower, which is what's been the case in last year, these types of rallies in commodities are not going to occur anymore. Commodity rallies are going to be smaller. They're going to be shorter. All right, so they're going to be basically short-lived rallies, bigger sell-offs, deeper sell-offs. So if you are looking to play commodities, I would say probably focus on selling large rallies as opposed to being a dip buyer, because I think we've kind of moved through the dip buying phase, at least for now. I think it's going to be a different story. I'll give you one more example of markets that became correlated that shouldn't be. And you can see there's definitely some manipulation here, maybe algos. There's really no good reason for gold and coffee to be trading exactly the same every single day. This was a red flag to us. I think both markets were probably brought up on speculative buying, panic buying in the case of gold. We're going to take a look at gold charts here in a couple of minutes. But when you see these types of correlations that don't make sense, it's not going to last. And I feel like we've seen coffee break. I think coffee, brown is obviously coffee. I think we continue to break and head lower. Gold, I think, is probably just starting the phase of moving lower, but they rallied together. They're probably going to sell off together. Coffee was probably the first to break, and I think gold follows. You're probably wondering why the heck gold follow coffee, and the reality is it shouldn't, but it probably will. That's just how markets go sometimes. This is a relationship between gold and the S&P 500. Most people assume that gold and stocks are going to move in the opposite direction. Gold is kind of expected to be a hedge against turmoil in the stock market, but we can see that's not the case. Gold is a diversifier. Sometimes it moves alongside the stock market. Sometimes it moves in the opposite direction. It actually has a mind of its own. The greatest thing about gold is it's not really a stable correlation with any asset. Sometimes it is, sometimes it isn't. It does its own thing. What makes me a little bit nervous here is we have both markets, both stocks and gold, going parabolic. This tells me if something goes south in the stock market, more south than what we've seen, the little correction we've seen obviously wasn't enough to do it. But if something goes south in the stock market, what people are going to do is they're going to sell their gold because they're raising cash. People tend to hit the sell button all at the same time. Sounds like the opposite of what you would assume to be the case. Most people would assume you would buy gold if stocks are going down, but they've gone up together. There's a good chance they go down together as well. This is the relationship between gold and treasuries, and it's very similar to treasuries versus the equity market. The relationship between gold and treasuries is they are both considered to be a safety asset. Now, treasuries have had just an awful couple of years, really just pathetic, to be honest. I mean, this is supposed to be a safety asset, and you can see it's been anything but. The greatest thing, the only thing good I can say about treasuries is they've been earning pretty good yield. So myself, I'm overweight in treasuries in my personal portfolio. It looks on paper like a terrible decision, but honestly, the income that's being generated is keeping up with the lack of appreciation. So it's all good. And if something does happen and we see treasuries rally, then not only are you getting the interest, but you also get that upside appreciation, which is going to be amazing. The problem with buying gold here is gold does not earn interest. So if you're buying gold at 3,000, you have absolutely no risk buffer, none at all. If you buy treasuries, you have a risk buffer. If you buy gold, no risk buffer. You're all in without a parachute. So for this particular reason, it makes sense, right? If you're looking at two safety assets and one pays interest and one doesn't, it makes sense to go for the one that pays interest, not necessarily the one that doesn't, even though that's, gold has obviously been in a bull market and maybe it continues to be. I personally have doubts. I'll show you why in a few minutes. You'll also notice that these two markets, they can trade together at times, but when they trade apart, what happens is gold is cheap and treasuries are expensive. People prefer gold because they're not giving up much interest to buy gold versus treasuries. But in this situation, if you buy gold, you're giving up 4 to 5% in interest to buy gold at an all-time high. Historically, that has not worked out well. Seasonally, gold tends to make a run early in the year, and then it has a rough summer. The best time to buy gold is usually late summer. I don't know why. I don't know what the cause is. For some reason, gold tends to have sometimes it's even a mini flash crash in July or August. And that's usually the point where it's the safest to be a gold bug or be a gold buyer. So keep an eye out for that, even if you're not necessarily willing to play the downside in gold. If you're looking to buy more, wait until July, August. The odds are you probably get a much better opportunity. One other thing that makes me think that gold might be on its last leg, this is the COT report. This green circle here and the blue circle here represent speculators. The blue line is funds. These are speculative funds. These are individual speculators, or large speculators is what they're called. And they've probably deployed most of their buying power because we've seen every time we get up to this general area of buying, the market tends to have made most of its move. Now in 2020, we saw a much bigger move. We were going through a COVID shutdown and all kinds of crazy stuff. I think we're seeing a bit of a repeat of this move here. And you can see that speculators got really long and they were right for a while and picked up a nice little gain. That was kind of the last 2 or 3 innings of the game, not the beginning of the game. This is a monthly chart of gold. I recall 2011 very, very well. In fact, I have a little bit of PTSD over 2011. In 2011, gold and silver were flying off the shelf. People could not get enough of it. All the same talking points were out there. Central banks are buying. The miners aren't catching up, but they will. There's nowhere else to put your money. The dollar's in trouble. All of these same stories that I read about every single day about gold were circulating. And that was about the peak. We had 3 waves and the RSI was overdone. By the end of the 3rd wave, that was it. The last buyer was in and we took 10 years to get back to that price. Do I think we're going to have a correction that is 45% deep and 10 years long? Probably not. I think these are faster moving markets. Electronic markets are a whole different animal. But I do think, believe it or not, the low 2000s are in play. 2170 would retest the breakout area. I know that seems like it's a long way away, but that was just a year and a half ago that we saw those prices. 2000 is not impossible. That would be a retest of the downtrend line. And the reason I'm pointing these out is if you're all in on gold and you've made some money, or not even all in, if you've just made some money in gold, you may want to consider protecting it or taking profits, because in the long run, if we're talking 40, 50 years, gold is a really great store of value. It has been historically, and it probably will continue to be. If we're talking about 5 to 10 years or 20 years, maybe not. Like if you bought in 2011, you would have had to hold, not earning interest and watching your capital burn by 45% just to get your money back. You had to hold 10 years just to get your money back. No interest. So you're missing out on all the interest you could have earned in treasuries or something else. And you're probably not having very much fun. So there is a time and place for gold, but it's just not all the time. It's not always. If you do own gold and you want to hedge it, or if you want to speculate a little and bet on the downside of gold with, right before I came in, I noticed a sentiment reading that we follow. 73% of industry insiders are bullish gold. That's generally a contrarian indicator. Usually when everybody's thinking the same thing, the market does the opposite. I think we all kind of know that by now. Unfortunately, we're humans, and so we want to be with the herd. It's more comfortable to have the same opinion as everyone else, but the reality is most people lose trading. Most people lose trading commodities or actively trading stocks, not investing in stocks, that's different. But active traders, most of them lose. And so if you are in the same position as everyone else or the same opinion as everyone else, you're probably not putting the odds in your favor. This is a trade that we sent to our clients on March 14th. I'm going to show you what it looks like in a chart in a few minutes, but it's a bear put spread with a naked call in gold. And what this means is we want to be short gold either as a speculation or even a hedge if you own some gold and you want to hedge it. But we want to give the market a lot of room to run. It's kind of a base hit strategy. We're not trying to hit a home run. At the time when we put this out, gold was roughly 3,000, give or take. I think it was maybe 3,030, somewhere in there. So we can be wrong by $450 before we really get into trouble, because where our risk is in that 3,500 call that we're selling to pay for our put spread. That's where our risk is, the 3,500 call. As long as the market's below 3,500 at expiration, it's kind of no harm, no foul. We paid a couple $100 to get into this trade. You can see that here. Margin's $5,000. If you have a $5,200 trading account, you don't want to put a trade like this in. You probably want at least $15,000, $20,000 to do a trade like this in your account. Otherwise, even though you have the margin to do it with much less, the problem is if gold has a big up day or a couple big up days, you could easily get squeezed out on a margin call, and you don't want to do that. That's no fun. But if you have a nicely funded account, you could do this trade and probably not sweat too much about it unless gold really takes off to the upside and goes parabolic. That's not impossible, but it's not likely. If we're just dead wrong, let's say our analysis is just complete garbage and gold runs above 3,500 before expiration, it's like being short a futures contract from 3,500. This trade with a $5,200 margin requirement could make as much as $98.50. This is before transaction costs. And we have about 136 days, at least we did at the time this email was sent to our clients, for this to work out. And all we needed to happen was gold to go below 2,900 for that maximum profit. Now, when I tell people that the maximum profit is X number of dollars, I make sure they understand we're not really going for that maximum profit. If we can make 3,000, 4,000 well before expiration, that is an amazing trade. So we're not always looking for that 10 grand profit, but we'll take it if it accidentally happens. This is what it looks like in a chart, and you can see why we might have did this. Market's coming up against some resistance here. And our short call is all the way up here. We don't lose money unless the market travels from here, around 3,000, all the way up to 3,500 at expiration. Before expiration, we can take some heat on that. And what I mean by that is the value of that short call option can increase and the value of our put spread can decrease even if gold doesn't get to 3,500. Let's say it gets to 3,300, but it does it quickly. We might take some heat on it. So there might be some paper losses, which is why I suggest doing it in an account bigger than 5,000. You'd want to do this in a $15,000 to $20,000 account. Ideally, what we're hoping happens is we hope gold holds here and heads down to the bottom of the trading range here. That would give us our maximum profit if we held all the way to expiration. Again, we're not really necessarily counting on that, but it would be nice if it happened. And one thing that makes us think that gold might be in trouble is we're looking at the RSI down here. You can see it happened here, and now it's happening here. And what I'm pointing out is, as the futures is making new highs, the RSI is not. So you can see the future made new highs here, but the RSI didn't follow. We made a high here, the future made a new high here, and then the RSI didn't follow. You can see what happened next in October, November, and we expect a very similar thing to happen here. Somebody's asking, why do people buy gold coins and bars? And I will answer that, or I will actually not answer that because I don't know why they do. To be honest, it's probably the worst way to hold metals. I mean, if you just want to buy a couple bars or a couple coins, that's no big deal. But if you're actually trying to accumulate wealth in a long time frame in a bigger size, it's just not the way to go. They're heavy, they're dirty, and they may not even be dirty, but they cost a lot to transport. Or if you're going to drive across town and with them in your trunk, do you feel comfortable to go to the gold and silver pawn shop on Las Vegas Boulevard? Are you going to feel comfortable getting out of your car with a whole bunch of, $20,000 worth of gold? I don't think so. I wouldn't. So I don't know. My personal opinion is if you want to own gold, do it in the futures markets. You can buy a micro contract The margin is about, I think it's about $1,500 on a micro contract that's 10 ounces. If you don't want to use margin, you don't have to. You could fully fund the account. So put $15,000 in the account, buy one micro. You could buy or sell it around the clock. The bid-ask spread's a dime. You don't have to pay, like if you buy gold and silver out of a physical shop, if you're holding the bullion, you'll literally get slipped 5 to 10% on the way in and on the way out. I mean, it's just a really big mess. And if you have a whole bunch of gold, I'm talking like big stockpiles of gold, millions. With gold at these prices, we've been getting phone calls from people trying to sell their gold in very big quantities. And guess what? Nobody wants to buy it from them because it's just too difficult to move around. I mean, it's really a pain in the butt. If you can't sell it, what's the point? That's my question. There are quite a few strategies out there that allow you to use the market's money. Oops. This is a trade that we sent out on about 3 weeks ago, I want to say. When we sent it out, I believe, now don't hold me 100% accountable, but I think when we did this trade, the market was right around here. So we were a little bit early. This was kind of scary, but it ended up working out fine. We actually took profits on this today. But it's a good idea to use the market's money when you can. In this particular situation, we were selling a natural gas call, which isn't always the greatest idea, but seasonality in natural gas tends to turn around March going into April because guess what? Winter's over and we don't have to worry about the surprise seasonal or surprise winter weather anymore. So we took advantage of this. Volatility was high. There's a lot of things going on. The new administration's pretty big on LNG, and so that pumped the market up a little bit. But the reality is anything LNG related is going to take a long time to actually materialize. And even when it does, the U.S. produces a lot of natural gas. We can produce a lot more without a whole lot more effort. There's actually natural gas producers out there that still flare their inventory. So like instead of actually selling it in the marketplace, they actually just burn it up to get rid of it because it's easier for them. So we have lots of natural gas out there. So we looked at this as an opportunity to put on a free trade. We sold a 650 call. We bought a 375 put. We used the market's money. I think we got into this for roughly even money or maybe even a small credit. The margin on it, I'm just kind of guessing. I apologize because I didn't paste the correct stats on that previous slide. But I believe the margin was about $3,000, 2,800 probably, $3,000. In this, on a trade like this, you're short the future from 650 if the market gets up there. Now, when we did this trade, the market was about 450, so we could be wrong by $2. So we used the market's money to pay for our 375 put. And the opportunity cost of doing that was accepting the margin requirement, accepting unlimited risk above 650, just being comfortable with that. 650 may, if you've only been following natural gas for the last couple of years, 650 might seem like it's doable, might seem like it's not that high of a price, but it actually is. Aside from the chaos that incurred in 2022, 2023, where natural gas went to $10, natural gas spent almost a decade trading between $2 and $3 prior to that. And I don't think we're going to get really anything, even in the most dire circumstances. I'd be hard pressed to see anything above 556. Now, anything's possible, but this is a very well supplied market. This is a market that speculators are almost always short for that reason. So anytime you see a really big natural gas rally, consider, and again, pay attention to the time of year. You wouldn't want to do something like this in December or January, but in March it wasn't too uncomfortable. And if you've never traded commodity options, don't do this without the help of a broker or a professional because it can be scary sometimes already. Okay, we're running a little short on time. I'm going to go through this real quick. This is a kind of a big picture of crude oil. I show this chart a lot. This isn't anything if you follow me on social media, you've probably seen this 100 times. But I like to show this so that people keep in mind how commodities work. You can see, everyone talks about inflation and commodities, and people expect commodity prices to be higher because time goes by and the law of inflation says they should be, but that's just not how it works. Commodities, we've never seen crude oil trade above $150 like it did in 2007. Yet in the meantime, we've had inflation for almost 20 years, and crude oil's at 78, not 178 or 278. And that's because technology is deflationary. As time goes on, we get better and better and better at producing oil. You can see this line here in the middle. This is the fracking line, I call it. Once we invented fracking, oil went from $105 to $30 pretty quickly. And we've kind of stabilized since then. But fracking was a game changer. So instead of trading up here, we traded in this lower range. Even the Russian invasion of Ukraine couldn't allow crude oil to hold above that, what I call the fracking line. Here we are now around 65. There's a lot of people looking to buy the dip here. I'm just not convinced. I see this trend line. I'm aware of it. It looks like it's really trying to hold. You can see this right here, this blue line. We've been holding this for years. But I've seen this before. I've seen it here. This is the exact same pattern. This is the exact same pattern. And the conclusion was very, very quiet. And then suddenly not quiet. Very, very quiet. And then we get a crash. Quiet. Do we get a crash? I think we might. For starters, I'm just looking for 50, not a crash. But I think a lot of people in their head from 70 to 50, they might think that's a crash because, maybe they weren't trading in 2008. But we could easily, you can see this line here is holding. We broke above it around Christmas, but I called that fake news. Happened in a very illiquid time of the year, and there wasn't a lot of volume, and then we fell back below it. So this trend line's pretty solid. As long as 70 holds, I think we get another crack at 65. The more we break on that or knock on that door, the more likely it is to collapse. And I think that's probably where we see $50 oil. This is a spread that we put on roughly around here. So we're talking, I want to say maybe early March, I believe. The idea was we're bearish crude oil. I just showed you the weekly and monthly chart. I just showed you that I think we're breaking a 50, but we're sitting on support and we were oversold. It's a little scary to sell crude oil into support. In fact, it's just a bad idea. It very, very rarely works. As you can see, I set up here, chasing oil lower into support hasn't worked. So we're not going to do it. So what we did instead is we put together a butterfly spread. We bought a May 65 put, we sold 2 May 60 puts, and we bought a 55 put. The purpose of this trade is to get in. We have limited risk because we're buying 2 options and we're selling 2 options. So if you're buying and selling the same number of options of the same type, your risk is limited. So we were able to get into this trade for about $550, no margin because our risk is limited. And it gives us the ability to make money from 65 down to 55. Now, it's clear that crude oil held support and rallied. I think this is going to be short-lived. I think this, you can see this trend line here is going to be resistance, and I think we come back down. But what we did today, actually, is these 60 puts had lost almost all their value. So they did their they served their purpose. We collected premium for these to pay for the 65 put and the 55 put. And today we were able to buy them back for about $100 a piece. So instead of our risk being $550, it's now $750, but we have unlimited profit potential. Whereas before we could only make money from 65 to 60, and then we gave money back from 60 to 55, meaning we could make roughly $4,500 if everything went perfect and the market was right here at expiration. But instead, this might actually work out better because now we have these puts are out off the table. They're gone. We're holding a 65 put and a 55 put. They're not worth a whole lot. I think this one's worth about $400, $450 at this point. But if oil comes back down sharply like it did here, and I think it might, we could easily be trading at 65 here in the next couple of days. These options have 20 days on them. So we're actually in a pretty good spot with limited risk. We use the market's money to mostly cover the cost of these, and we'll just see what happens. Thank you for coming. I'm sorry I screwed up a couple of those slides. I apologize. If you want to follow some of the trading ideas and analysis that we put out, you can sign up for a free trial on our website. It's decarleytrading.com. Here's my contact information. I'm going to show you our website here. Okay, here we go. So decarleytrading.com, there's a button over here to click on newsletter trial and you can sign up. We have about 3 minutes left. Are there any questions? Okay, somebody's asking about silver. I am not a fan of silver. Unfortunately, I don't have my trading platform up, so I can't really show you a chart. Shoot. If you email me, here's my email address, cgarner@decarleytrading.com. I'll send you a chart of silver, that one that I'm following and where my critical points are. But to be 100% honest, silver's just not my cup of tea. I don't know why. I should also have shared, and if you email me, I'll send it out to you. There's a interesting chart on the spread between gold and silver. And a lot of people think that silver is going to catch up to gold, and it might, but I don't think that's going to be the case. What I think is going to be the case is I think gold is actually going to sell off to come back down to silver. I do think the spread between the two are going to narrow, but I just think it's going to be from gold weakness as opposed to silver strength. Okay, thank you. Any other questions that I missed, maybe? Somebody's asking if I look at Bitcoin versus other commodities. To be honest, I don't. Bitcoin, I'm too old. I think I'm too old for Bitcoin. I don't really understand it. I think the technology is amazing. I think the technology is going to be useful. I just have a hard time grasping that one particular coin is going to be the one that we ride into the sunset on. So I'm not a huge Bitcoin follower, but I do look at it. And I do watch some of the relationships between Bitcoin and gold. At one time, there was a lot of talk about Bitcoin replacing gold, and for a while, gold kind of suffered because of that, but I think that gold's proven that it's doing just fine. I do actually think the spread between gold and Bitcoin probably will narrow as well, not for any other reason than I think one's probably far overvalued, which is gold. Well, I thank everybody for coming out. I appreciate it. If you have any questions or comments or concerns, you can reach me here at this email address and that phone number. Thank you.